Hi, this is Joseph. It's Tuesday. It's September 15th. We're looking at the pound dollar. So I wanted to give you a quick update on some of the trades that we've executed using the wave counting method, key support and resistance levels, and using my point and figure techniques. So we had a total of 3 trades. The first one paid 20 pips, the second one paid 34 pips, and then the final trade paid 39 pips. Let me walk you through a couple of them, though. This was the pound dollar, and this is the initial first setup here. We had 2 trades on the pound dollar, and this was to the upside just as the market was opening. So I'm going to show you in just a moment what that looks like and why or how I was able to find the top and the final target here at 20. This was just sort of a blow-off move right when the London market opened. Psychological level 20, entry at 98. And then, of course, we traded this to the downside. Let me show you what it actually looked like here on the chart. So this is the pound, and this candle right here is actually the first 1 hour candle at the start of the London session. I have a trading strategy that I call the London breakout strategy, and it's you probably have seen it here in the Facebook group. I also have it on my YouTube channel. It's a basic trading system. It's not too complicated. It's not too elaborate. It's just a trading system that you do need to use some discretion with. You need to figure out how to filter some of the bad trades. That's the important thing, is that with a lot of trading systems, if they're real basic, real generic, if they use simple moving averages or simple indicators and things like that, they need some kind of a filter so that you can eliminate those head fakes, I guess I could call them. Head fakes, moves, trades that don't work out. They're bound to happen, because this London breakout strategy doesn't always work. And I stay away from using it unless it lines up just like I'm going to show you today. So again, it works, but you have to have methods of filtering out the bad trades. Let me show you what that looked like. So again, with the breakout, I wait until there's a break of the first 30-minute candle in any direction, whether it's to the upside or to the downside. And sometimes you can see that if it's bouncing off of support at that time when the London market's open, sometimes you can trade that bounce as a double bottom, or it might trade off of the previous day's low. And in this case, it was sort of stuck in the middle of that range. And this was yesterday's high. So it was pretty obvious at that point when we saw volume levels start to come back in, and this was already on its way up a few hours before the London market opened anyway. But this is what it looked like on the point and figure chart. There was that range of resistance as it was running into that high, and then it eventually broke out to the upside. It did pull back and then continued its move right back up to the target of 20. Pullbacks are typical. They don't always happen, but they are very typical, and you have to know how to deal with them and how to prepare for them, how to trade them. So again, an entry at 98, the target was 20. That worked out just fine. So again, this was at the same time that the London breakout strategy was developing. Now, if I had to choose between the two, I would ignore the London breakout strategy because it's hit or miss very often unless you know how to read support and resistance, you know how to read volume, you know how to figure out if it's, or have ways to figure out if it's going to be a head fake, to filter out the bad trades. If you don't have methods for doing that, if you can't read the markets, if you can't determine where support or resistance is, and you don't have access to volume, and you don't have methods to filter out bad trades, let's say you just don't have enough experience to be able to do that, then I would avoid trading the London breakout strategy, and I would recommend sticking with the point and figure charts. As you know, I'm a big fan of point and figure. I've used them for many, many years, and it keeps me out of trouble. It keeps me out of trouble, meaning that if it turns out to be a head fake, I usually don't end up getting a signal on the point and figure anyway. So I avoid getting in those head fakes or those trades that fail because I'm using point and figure, and it works out just fine. Now, the reason I selected 20 is the fact that we've already been trading the pound dollar to the upside for the last few days anyway. And the other issue, again, is that it was running into yesterday's high, and it looked likely to stop. This was a few hours after the market opened. That high right there is at, that was 7 a.m. New York time. That's when it topped out right there. So again, I was done with the trade, and then I started looking for opportunities to reverse my trades. In other words, sell instead of buy opportunities here. But I needed a signal. And you can clearly see with volume as it starts to pick right back up. I'll go ahead and go to that candle right there and see if you can identify it. You can see here with the volume levels, we were seeing a definite change in character. We were seeing a change here in the market. This was the strongest candle since the previous day. That candle right there was at 10 a.m. New York time. This candle here today was at 8 a.m. New York time. So this was my reversal signal candle right here. That's all I had to do was wait for it. At the same time, I'm watching my point and figure charts bounce around here at resistance, and here is where it finally broke down and gave me the entry at 97. The entry at 97, based on the data that I had here, my target was 50. That produced approximately 39 pips with the spread and where I got into the trade. So again, 39 pips to the downside. This is a good clean trade. You can see how, again, it starts to make its move. It comes back up. We get the little pullback, and then it bounces around, and it continues right back down towards the target of 50. There's really nothing to worry about when you learn to read these charts correctly and you're using the appropriate take profit levels. That's what I see far too often with amateur or inexperienced traders, is they hold onto their trades too long. They don't know where to lock in profits, and they usually end up giving back all of the profits that they earn. They don't know where to close out the trade. Using this method, you know precisely where to close out these trades. And then at that point, when it bottoms out and it hits my final target, I'm done with the trade. So again, there was a total of 3 trades. The first one paid 20 pips. The second trade paid 34 pips. And the last trade paid a total of 39 pips. We had 2 trades here on the pound dollar. And between all 3 trades, there was a total of 93 pips profit. That's not double counting. So this can be done on any time frame. This can be done on any currency pair. And it can be done with any size trading account. Once you learn the mechanics and the basic structure of why price moves and how people react to it, how the market's going to react, and you have clearly defined entries and take profit levels and stop loss, you know how to confidently manage the trade, and you confidently take profits where you're supposed to. I'm going to be dropping in a few more videos on this particular setup throughout the rest of this week. I'm also going to be posting another strategy that I use called the continuation breakout trade. And you'll be impressed at how many pips it actually generates when you use the continuation breakout trade strategy. Me and my coaching students traded that method a few days back, and we earned 250 pips trading the pound yen on a breakout. 250 pips. Again, I'm not double counting. That's from the entry to the final target. And if you'd like to learn how to earn 250 pips trading the pound yen from the entry to the final target, watch that video. I'm going to drop that video here in the next 24 hours. It's called the continuation breakout trade. Thanks for watching this video. And as always, if you have any questions, please post them just below this video in the comments section.